Welcome to Friday Live. Every Friday, the partners of HPK Provident gets together and talk about the latest trends that we're seeing in the markets and the economy. And every now and then we have a special guest. So with us today is Michael Iltis, formerly of Iltis Lending Group. So Mike, thanks for being with us today.
Thank you for having me. Hello, everybody.
And since I saw you're wearing your old football team shirt, Colorado, how about your boy Travis Hunter?
Yeah, you're up in Jacksonville, so you're a Jaguars fan.
I am. I'm
Yeah,
finally getting into football.
yeah, he's a good asset for the team, and
Oh,
I think
he's such an athlete.
yeah, and they're incorporating him. They got a lot of talent on that team, so he's getting incorporated in. To see him take the opportunities thrown his way and make some good things out of it, it's cool to see. So I'm
Yeah.
excited for him and the Jaguars.
Yeah, me too. It's been fun to watch. Although last week was kind of brutal.
Yeah, it's crazy this day and age. You got the Eagles losing, what was it, back to back? Bills, like it's any given Sunday, especially now more than ever. Teams can surprise week after week, and really it's early yet, so we'll see
Yeah.
where all the chips fall.
All right, so we're going to get into the markets a little bit, the economy, and then I'm going to ask you some questions about what you saw in the mortgage industry. So if
Okay.
that framework's good, let's get ahead and get going. So this is the S&P 500. We are kind of just trying to figure out which direction we want to go. We had that big down day on Friday, and it's just been very volatile intraday. Even today, we're about the flat line right now, but futures are down, I think, close to 1%. So the market's trying to figure out which way to go. We're in that vacuum of no economic data, with the government shutdown being, I think, 17 days in at this point. We had that failed vote in the Senate yesterday. So the shutdown continues. It's just childish politics continuing on. We've seen it before, and we'll continue to see it. So we've been trying to rely just on the survey data we've gotten. We had the small business survey come out, came in a little lower than expected. The biggest concern for small businesses is inflation, and the 58% of companies, small business companies that are looking for employees, they're not really finding any qualified applicants. You turn to the beige book, which kind of shows a little different picture. Many districts are noting a reduction in labor force, and that's mainly through companies are starting to lay off. So that's contrary to what we saw from remarks of Powell this week. He was speaking at some symposium. He says, the employment situation's decent. Both demand for labor and hiring is slow. So we're kind of in that environment of not many layoffs, but the pace of hiring is really stalled out. So I think this is a good segue. This is a picture of the 10-year Treasury. We broke 4% yesterday. We had a little bit of a regional bank scare with some large loan write-offs, but I think this is a perfect transition into you talking a little bit about the mortgage industry. So you were a mortgage broker for over a decade.
Yeah, so I joined in 2012.
Okay, and then that continued up until early this year. Was it March?
About 3 months ago. Yeah, I closed officially down. I want to say it was the end of April, right before Stacy and I had our baby.
Okay, so now you're studying to be a CPA.
Yeah, so the mortgage industry had been a great industry to be in. Over the 10 years, it had some great opportunities of growth there during 2018 and 2020. But it's changed a lot and became extremely saturated. So with Stacy and I having our baby back in June, she's pretty, her job demands a lot of her.
Mm-hmm.
It seemed like a good opportunity to take some time and transition into a different field, and accounting is what I chose. And so I've been studying, getting credits for my minimum credit hours for the state of Florida, and starting in January, I'll start sitting to take the first part of the exam.
Okay.
So I
Do you
got a
want
little
to
bit of
talk a
ways
little bit
ahead of
about
me.
you want to talk a little bit about the paper you're writing right now? I was finding
Yeah,
that
so
pretty
I'm
interesting and
actually
very relevant.
I'm in government accounting. It's government and not for profit accounting, and we have a research paper as part of our big project for the class. It's actually due this week, and I chose to write it on the federal budget. And when we started this about a month and a half ago, things were a little different in terms of we weren't shut down. Things were still moving along there. So there's been some updates, and the CBO, Congressional Budget Office, actually put a new updated forecast for the economic forecast because of some of the things they're seeing through tariffs and for the economy and the interest rates and changes there. So they just released that actually in September. And with the 10-year Treasury, it's interesting because we came down below 4, kind of sitting right around 4 there. The 10-year Treasury doesn't really move dramatically. I mean, it can move dramatically, but it usually stays within a range, whether it's moving flat, down, or up over a period of time. So the CBO projection is saying, based on what their numbers that they're looking at for the economy, that we'll see a 10-year Treasury of 3.9 in fourth quarter of 2028. So that kind of, that's a few years away, right? And we're kind of sitting there right now. So there may be some, bounce back up into the low 4s and kind of like a drawn out downward, settling down into those 3s, just like you're seeing on that chart Mike had, where it's heading down
Yeah,
over
it's definitely a
time. So
downtrend from
downtrend. There
early
you
in
go.
the year. But if you look at a long-term chart, 40 years, we definitely broke that previous downtrend from the 1980s. So um, that signals that longer term, we're probably going to be in more of an uptrend, even though this chart is showing a downtrend in the intermediate
Yeah.
time frame. And there's a lot of dynamics to that. Inflation might be running a little hotter. As you mentioned, the deficit, it's very large, so that's going to keep the pressure a little higher. And that's really a tough dynamic because I think I saw in that report that we are now paying $1 trillion in interest a year.
Yeah, I think also it said that the deficit is going to continue to expand over the next 30 years. Not much. I think the average is like somewhere in the 6% of GDP, but it's definitely in their projections, it's going to continue to widen over that next 30 years into 2055. So that net interest, yeah, obviously with the high rates, the $1 trillion in interest payments, every month. That's a lot. I mean, that's a
Yeah,
lot. And if that's going to continue to grow, it's not going to help our situation. That's going to keep things stressed for an extended period of time. And then you have the issues with the funding for, Social Security, Medicare, Medicaid. All those things are going to continue to be at the forefront of these, budget debates. So it's going to be
right.
interesting to see how all that unfolds. Um, because a growing deficit over the next 30 years, it's not exactly where we want to be, I don't think.
No, not a good thing.
Yeah.
But for the markets, it's not a problem until it is.
Yeah.
So the markets can ignore that for a long, long time, maybe our entire lifetime, but at
Yeah.
some point they could care about it. And
Absolutely.
usually that we get a little bit of a price shock when we have a shutdown or something, and the market doesn't really react to the shutdown. But then maybe in a couple of weeks we get a downgrade to our U.S. government debt, and sometimes that shocks the market a little bit. So we'll have to see if that occurs. Right now we're entering the third week, I think, of the shutdown, and it takes about a tenth off GDP each
Okay.
week. So the longer this goes on, the more economic impact it'll have. So we'll just have to keep an eye on it. Hopefully next week's the week that we
Yeah.
reopen and get things going. But let's hop back into the mortgage industry. So obviously, the last
Yeah.
couple of years were very difficult with that 40-year high inflation really causing rates to rise. So how did that affect your volume of business? And did it have any effect on home prices or anything else you're seeing?
So initially, when rates initially had that initial, spike, what was that, a little over 3 years ago?
Mhm.
You know, I think it was 10 or 12 of my mortgage contracts applications were had clients buying, and we were going to be closing on loans. They all canceled because of the uncertainty. So, in the mortgage industry, there was a very immediate reduction in volume. Things stayed steady, obviously not at the levels of 2020 and 2020, 2018, 2019, 2020, when there was all that migration right before COVID and then after COVID. That volume was the highest probably it had ever been, but things were steady. Volume was steady. People were still buying and moving. Prices stayed in Sarasota area and in parts of Florida in general. Prices stayed high, maybe not appreciating at the same level where you had multiple offers going 50,000 over asking price.
Mhm.
You had people coming in and still paying asking price. Um, and so those prices stayed elevated. They didn't continue to skyrocket, but they stayed elevated for, a couple years there. And then in the last year and a half, you've seen, those values come down, especially kind of in that range of 500 to, 1.2 here, 1.5 in like the Sarasota Manatee area. That's kind of our general area. So volume after rates spiked, definitely a big chunk of volume came off the top. As rates stayed elevated for a period of time, it chipped away at the volume because prices were high, rates were high, loan amounts were high, which means payments, were significantly higher, two, three, sometimes four times higher than what people were paying with their 3%, 2% mortgage rates.
Yeah.
And one of the things people like to compare, initially they were like, well, back in the 70s, there were 13%, 14% interest rates, but the loan amounts were 50,000, 60,000,
Right.
$70,000, not 300, 400, 500, 600,000. So payments are almost five, six, seven times more
Yeah.
um, than they were back then. So,
Yeah,
and people,
affordability is so tough right now. Like for a
yeah,
family to buy a house, um, you're looking at 500,000 for something probably pretty small in Florida, and
yeah.
then interest rates being 6%. It's tough for people to afford.
Oh yeah, it eats up all their income. Just and it's hard to qualify in some areas, especially. One thing that has happened here recently is, um, 500,000, I think, across the United States, 500,000 more sellers than buyers. So inventory as a net excess of 500,000. And then a lot of people in Florida, Sarasota area, can weather the storm longer. So people are delisting their houses rather than, people have come down in price, sure, but only so much, right? And a lot of people are now delisting. So cancellations and delistings have been accelerating in the last couple months. Um, and a little bit of spike here in volume with the softening of the 10-year and Jerome's speech about interest rates cuts going into next year and all that. So I
Mhm.
think it does spur every time that happens. There's some positivity in the market, either with prices or rates or something of that matter. People do jump back in briefly, and there's a little spike there, but ultimately buyers have pumped the brakes. They're not, going to pay more than what they can afford. I don't think people are making more money than they were maybe 2, 3 years ago. Some sellers, bought at a really high time, at the peak of prices, and they're probably down, you know, 10, 15, maybe even
Mhm.
20%.
Yeah.
Um, and if they're not forced to sell, they'll kind of sit there and hold on to it. So right now, volume's coming way down, especially in the last probably year in the mortgage industry. You've seen, maybe in a year and a half, volume take a big hit. There's still business out there. There's the deals are harder to do. You have to. I was a mortgage broker, so I had access to hundreds of different lenders across the country, and some offer hundreds of different scenarios that others won't fund. And so
Right.
you got to kind of, do a little shopping. If you're a bread butter kind of, income, history of employment, assets, all that stuff, a bank or a broker, go shop around, get a good rate. If you're going somewhere and they're telling you no, or they're not giving you the time of day, you might be a tougher circumstance to qualify. You might have to call a few more people and try a little harder. It's the deals are harder to get done. The lending guidelines are a little stricter. I think credit has changed a little bit too. That's one of the things that we saw initially when rates spiked over that next 6 to 8 month period. Following that, FICO scores were coming in funky, and it was interesting to see how Equifax, TransUnion, Experian were reallocating their model to increase the level of risk of people just based on what was going on in the economy. So it was interesting, to see all that unfold. But where we go from here, I'm not so sure. I think as long as things stay unaffordable for a lot of people, you're just going to see people struggle to buy and sellers to sell.
Mhm.
And it may just kind of be a little bit like that for another year or two, until some things start to normalize a little bit more. So
And
we'll see.
I'm really mixed whether like if we so we're re-entering the rate cutting cycle. If we get a substantial decrease in the short end, that doesn't necessarily mean that's going to be reflected in the long end in mortgage rates,
Yeah.
given some of these dynamics we talked about with the debt level. But if it does come down, do you think? I asked my realtor this a couple weeks ago too. Do you think that's going to flood the market with inventory for those people that have been waiting to sell their homes for the last couple years?
I've been thinking about this for the last couple months, like really hard, because I have a lot of friends that are realtors. I still see a lot of real estate information. I stay tuned in. I read on a lot of stuff, and I think I ponder and try to figure out for my own theories, kind of what I think is going to happen. And I kind of feel like, you know, I think things are going to kind of be stagnant for a little bit. I think if rates stay where they are, within a quarter of a percent either way, maybe half percent, that's still not that much of a move as long as
Mhm.
prices stay high for a lot of people. So if prices stay high and rates kind of fluctuate a half percent down and up from where we are now, I don't think you're going to see a whole lot change. Now, if rates did come down, the 10-year, gets down to 3.7, 3.6, you're probably looking at 30 years in the low fives and 15 years in the mid fours. Arms may come back if things normalize and there'll be more opportunity there. You may see, if buyers start flooding the market, you may see sellers. But the issue that's still going to rise is the sellers. Do they have to sell? Do the people here that have second homes and investment properties that, they're retired, they have large net worths, are they going to sell it for a loss? And are they just going to keep it and hold on to it for a longer period of time? So I think there are people that are probably desperate to sell. And depending on where prices go, if rates do drop enough, I think demand would pick back up in this area, in desirable areas in Florida, and you're going to see prices kind of stay kind of in that
Mhm.
elevated range. I don't know how much more they will drop, unless there was a capitulation in the economy, and
Right.
people were forced by just the like a deep recession or something, they would be forced to sell. But assuming everything's normal, I think we're kind of going to be stagnant. Prices are going to kind of stay where they are now. You may see some opportunities if people are in a tight spot and they just need to get rid of something. You may see that, but I don't think you're going to see a whole flood of, homes reach the market at reduced prices because there's a fire sale.
Mm,
unless some type of capitulation in the overall economy.
yeah.
So I think it's just kind of going to be stagnant. I really do. I just think it's going to be like this for probably a while. At least another year, if not, maybe 1 to 3 years for all this to kind of settle itself out
Yeah.
under kind of where things are normally.
You mentioned arms, and I actually did one for the house I bought about 3, 4 months ago, and I saw a recent stat that we're starting to see a big uptick in arms. I did a 7-1 arm.
Yeah.
Can you discuss that product and how exactly it works and
Yeah.
how
So
they
the
differ?
The adjustable rate, will lock in a rate at closing for a fixed period. And, sometimes it's a 3 year arm, a 5 year arm, 7 year arm, 10 year arm. I'm sure some banks get a little bit more creative and they may go in between those numbers. And so the first number in the ARM product is the number of years that the rate is fixed once you close. So if it's let's just say a 5-1 ARM fixed for 5 years, the one means after that 5 year period, the rate will adjust every year based on where the current market rates are. So, if you get an ARM with the anticipation that you're either going to pay that loan off by the end of the fixed rate period, or you anticipate rates will be lower at the end of that fixed rate period and you'll refinance into a fixed rate loan at that time. That's kind of the thought process there, because the rates right now for arms can be, 1.5, in some cases 2%, maybe cheaper than a fixed rate, just depending on what banks are offering or mortgage brokers are offering. So the arm, is a good opportunity to take advantage of doing things today with a cheaper rate than you would at a fixed rate, with the anticipation that you're going to refinance out of that rate or pay that loan off before the adjustment period.
Mhm.
So
And I think with mine, and it's probably with all of them, but I could be wrong on that. There's a cap that they can't go above a certain.
yeah, they're caps. So they have like the 225 cap is typical, meaning that the first adjustment after the fixed period, it can't go more than 2% of the initial note rate when you closed. Every subsequent period after that, it can't go up more than 2% at a time, and then above 2% above what the rate was when you closed. And then the third number, the five, would be the lifetime cap of 5% above what your closing rate is. So let's just say if the rate's 6.5%, the first adjustment period, if rates were over 8.5%, it would be capped at 8.5. So it would go
Okay.
from 6.5 to 8.5. After that, every period after that, it would be capped at no more than 2% as well. So, worst case scenario, let's say you close at 6.5, 5 years later, your first adjustment comes. Let's just say rates went higher, and it adjusts to 8.5%. The next year after that, when it adjusts again, it would be capped again at going up no more than 2% from that rate. So 8, 9, 10.5%. But the lifetime cap is 5 above the 6.5, meaning 11.5% would be the max it could ever go during the life of the loan. So there are caps in there, and I just, from a worst case scenario perspective, if rates were going higher, that's where you would see the benefit of that. Now, obviously, if rates go lower, nobody's worried about that. That's what everybody wants, right?
Mhm.
You get an
That's the
arm,
plan.
rates go lower, and then you're saving 1-2% when it adjusts. That'd be ideal, obviously.
Well, yeah, great insight, Mike.
Yeah.
Anything else you want to add before we flip on the disclosures and start our weekend?
No, I think if you're anxious to get into a house, all other things, equal, if you plan on being somewhere for a long period of time, just look actively, have a price set in your mind, talk to a lender and find out what you can afford, and just be patient and look and see what's out there. And it may be one of those things where you got to look for a while. You might have to
Mm,
look for 6, 12, 18 months for you to find that right circumstance. Don't be discouraged by it. It's just you got to work a little harder these days than when things were flowing so easily. So
Right.
things will normalize and stabilize at some point. Just keep living your life and work with good brokers, good bankers. Always shop around. If you're gonna get a mortgage, see what the bank has to say. Get a referral for a broker from a realtor. Talk to them both. Don't sell yourself short. You may get different things. Not all banks and brokers offer the same products, have the best pricing for all the products. Shopping around, you really gotta to see what's available. You gotta put in that work. So I recommend that.
Well, thanks for joining, Mike. This was great.
Yes, sir. All right. Thanks, Mike.
And join us every Friday at 12:30 Eastern time. Next week, you'll just have Brian Peluso. I will be on my wedding cruise. So looking forward to that. The big day is Wednesday. So I'm sure I'll be posting some pictures on our HBK Facebook page. But yeah, we're looking forward to it.
Congratulations again, Mike.
Thanks. I appreciate it. All right. I'm going to flip on the disclosures. You can feel free to hop off whenever you want.
All right, man.
All right. Thanks again.
Yep. See ya.
Securities offered through LPL Financial, LLC, member FINRA, and SIPC.org. Advisory services offered through LPL Financial, LLC, a registered investment advisor. Brian Peluso, Michael Kutch, and David Harper are registered representatives of LPL Financial, LLC. Content discussed is for informational purposes only and not intended as an offer or solicitation to buy or sell any security or investment strategy. Any opinions expressed are those of the authors and do not necessarily reflect the views of LPL Financial or its affiliates. All investments involve risk, including the possible loss of principal. This communication may include links or references to third-party websites. These links are provided as a convenience only. LPL Financial and its representatives are not responsible for the accuracy or content of such sites. Brian, Mike, and David and HBK Provident Advisors may only transact business in states where they are properly registered or exempt from registration. Please